Close here, rates pulling back a bit, and that is helping things as they ease off their recent highs. Our next guest says equities are going to continue to climb higher, rallying strongly perhaps over the next 8 weeks. Tom Lee, he's the co-founder of Fundstrat Global Advisors. He's with us now. Welcome back.
Thanks, Scott.
8-week rally? What gets us there?
Well, first of all, I think this was an important week because the market was testing key levels and we had some hot data, but we held the 200-day. But now we're entering what I think is a very strong seasonal period. The next 8 weeks, the S&P could rally as much as 7%. It has a lot to do with the strength shown in January. I think it's going to coincide with the Fed sort of dampening those hawkish tones, and I think people may start to hear the Fed say 25 even though the data's been hot. And we get some inflation data starting next week that I think will sort of take people off the edge that inflation and the growth is accelerating. And I think that combination plus the market at 14.8 times ex-FANG means you got good risk reward. And if VIX falls, yeah, I think it's going to be, maybe S&P 4,200 or something by the end of April.
Wow. Are you unnerved at all by the move that we've seen in rates? Now, I mean, over the last day, they've taken a breather, but we were above 4% on the 10-year yesterday, and the 2-year was marching towards 5.
Yeah, I mean, rates is a big deal because, the rates market affects how you want to value equities. So seeing the 10-year at 4% is pretty alarming. And of course, the bond market is quite smart. It does seem like it's been overly reactive to inflationary data. So I think next week it'll be interesting to see how it reacts to Powell's testimony on the 8th and to the jobs report, and then to the inflation print starting to come. But we're expecting a lot of this sort of hard data and soft data to soften, and I think yields and bond volatility is going to fall. So
I know you need volatility probably to fall, but you need bond yields to fall to get to your 42.50 by the end of April, don't you?
Correct. I think if inflationary data is stronger in February and the jobs data, let's say it's over 250,000 jobs, then it makes it harder to argue for equities to rally because it puts more pressure on the Fed to do more.
So all the marbles come down, just like Professor Siegel was saying. Everything comes down to next Friday's jobs report.
Yeah, but I think we do have to be mindful. We had over 500,000 for January, so something even in the 250, which is above consensus, would be considered a significant improvement in the pace of jobs growth. Not that I want the economy to lose jobs, but growing faster than the employment force is growing is bad news.
What do I do with the fact, and I know you think about where earnings are, expectations, estimates are coming down. So as long as estimates are coming down, how can we have really any kind of sustained move higher in stocks?
Well, I think the two groups to really watch are industrials and technology, because they are very sensitive to financial conditions. On the tech side, I think many have noticed tech earnings estimates have actually been flattening. 7 out of the 13 groups have actually seen estimates for this year increase. So the industry is actually seeing stable to possibly rising earnings forecasts for this year for
because
tech.
But overall now, as I was saying with Professor Siegel, we're at $222, right, from a high water mark of 250.
Yeah.
There's no indication that that trend is going to just stop going down at this current time. We're still waiting for lag effects from the Fed tightening to take
that's right.
hold, aren't we?
Yeah, Scott, you're talking about 2023 earnings, though. And, the market's really going to key off 2024. And I think that all the things that we're seeing, especially regarding inflation, aren't taking away from 2024 as much unless the dollar is strengthening. And right now the dollar's been stable to flattening.
So you're telling me the market is going to be anticipatory enough to look towards next year and ignore where earnings are now? You think we're close to troughing? Because you have to be close to troughing if the market's going to have the ability to look towards the other side, right?
Yeah. I would say 2022 is a great example. 2022 earnings were up, but the market was down because 2023 earnings are down. So the path of the markets this year is going to be a lot of what rates do, what volatility does, but it's really 2024 EPS, which hasn't been hit as hard as 2023.
And you're still a believer in the FANG trade. I'm looking squarely at Apple, got back over 150 today. interesting level. Meta has been rallying as well, and that's where you think the money still is going to go.
Yeah, I mean, one, if you look at it from a technical perspective, these have all broken the 2021 downtrends. I mean, so they're actually now in new uptrends. And then these are groups where, and look at Meta, earnings estimates have actually been going up. So after getting cut for a long time, they're actually starting to rise. So I think you have a fundamental and a technical case to be long FANG.
All right, that's good to see you right here at Post 9. Tom Lee
Great.
of Fundstrat joining us. Up next, some more big stock moves you need to watch as